Let me welcome a very special guest on the show today, Mohamed El-Erian, the Chief Economic Advisor at Allianz, and someone who has been keenly tracking and closely observing the dynamics that we're seeing currently globally with regards to economic growth, central banks, and lots more. Mohamed, great to have you with us. Let's get started by really talking about the big event risk that's out of the way, the G20. Do you feel that, markets, of course, enthused by the fact that the build-up and that potential blowout war is now out of the question? However, does uncertainty with regards to a clear resolution still loom?
So I think what we got out of the G20 is a ceasefire or a truce. We did not get resolution. And I think that's important when you think of the economic effects. Businesses have to plan over a much longer period than financial markets. And until we get a resolution, we will have a high level of uncertainty. So I don't think that the G20 outcome changes anything in terms of economics. What it does do is changes the financial market. The financial markets got what they wanted, which is an outcome that doesn't threaten the possibility of the Federal Reserve cutting rates, but a good enough outcome to hope that you'll get further resolution down the road. So what came out is good for the markets, but still uncertain for the economy.
Mohamed, you've said clearly that you don't anticipate a recession in the rest of 2019 or 2020. Do you still maintain that, and do you feel that the potential threat to the economy was overblown, or do we still see a substantial risk?
So they pose a threat for the rest of the world because they are part of a process that started first with NAFTA, and now it's China, and next is going to be Europe, of the US redefining its trading relations with the rest of the world. So the rest of the world does face significant uncertainty. The US is still, like India, a relatively closed economy. So it can navigate this global uncertainty better than the rest of the world. That's why I see growth slowing down in the rest of the world. But absent a policy mistake or a market accident, the US should avoid recession both this year and next.
So is what markets really need to accept is a fact that we're heading or are already in a period of slower growth, that's really the new normal?
Yes, we have entered a period of stagnant growth, particularly in Europe. So if you're concerned about the global economy, look at Europe. I think of this as, think of a cricket team. Think that India is fielding a cricket team. And the first comment you get is your five main difference maker, be they bowlers or be they batters, your five main difference makers are all below potential. That's what's happening in Europe. The UK with the Brexit uncertainty. Germany with a political transition that's highly uncertain. France with political opposition, popular opposition to reforms. Spain and Italy with governments still trying to find their way. Your five main difference makers in Europe are all facing difficulties. In addition, there's no teamwork. So if this is a cricket team, you would worry about how well it can do on the international stage. And that's the reality of Europe. It's looking at the possibility of sub 1% growth. And that means the risk of stall speed.
But then how will this slowdown in Europe, which you've said is underplayed currently, really affect global dynamics? The US, you said, is relatively better placed than what we may see around the rest of the world. Just talk to us about how you see these relationships changing and panning out.
So we'll make global dynamics more uncertain. It will be a problem if you're a small, open economy. India has the better initial conditions for this world. In this world, you want to have initial conditions that speak to you being large, with a big domestic market, and relatively closed. That is what the US is. That is what, to a certain extent, India is. So if you have these initial conditions, you will navigate a more uncertain environment better. But remember, it is very hard to be a good house in a worsening neighborhood. You've got to get your policies correct consistently.
Mohammed, where do you see the biggest vulnerability then for the US in terms of policy risk, perhaps, or pain points? Where do you think they're going wrong? Where do you feel perhaps the maximum risk is to the system?
I think the two biggest challenges for US economic policies are as follows. One is to continue with pro-growth reforms. The US economy got a boost from the tax cuts and also from deregulation. But if it doesn't add to that with more pro-growth policies, that boost is going to run out. And the most important pro-growth policy right now is infrastructure. There is urgent need to modernize the infrastructure. So that's the first issue, and it's really political. Most economists agree on that importance. So that's the first challenge. The second challenge is the Federal Reserve. It is in a very tough position. Like the ECB, it has carried the burden of growth for a long time, and its policies are not that effective. They come with costs and risks, with the risk of collateral damage. And the Fed right now is being pushed very hard by markets to be ultra stimulative. And there's a risk involved here in creating a financial accident down the road. So my two major policy areas that I monitor on a high frequency basis are infrastructure investment and the Federal Reserve.
We've been talking a lot about the kind of pressure that the Fed is under. We've been seeing that, of course, with regards to, the kind of tweets that we see from President Trump and the latest in terms of his new nominations or candidates that he's thinking of for the Fed. But you've talked about this as well, that politics is going to play a bigger role when it comes to the central bank and its actions, and that they're actually overtaking economics, that those pressures may actually lead to perhaps market accidents going forward. The Fed is fighting a tough fight right now, Mohammed. How do you see this panning out now going forward? Will they be able to really make decisions based on pure economic fundamentals, or are things going to change?
Yes, and not only in the US. I think that is a global environment. Policy makers have been overly reliant on one tool, monetary policy, and they haven't deployed the full range of tools. And that's because the politics in the West has been so complicated. Because of that, central banks have taken on enormous responsibility, and now they're being pressed to do even more. But their tools are not well suited for this challenge, so they're very easy to blame. This is a hard time to be an independent central bank, and whether you look at what's happening in Europe, in the US, or even in a number of emerging economies, the political pressure on central banks is only going to go up.
Okay, so we've seen a flip-flop on rates. You're saying there isn't always appropriate policy action or use of tools to make significant impact. Miscommunication risks that continue as well. So that's a really tough balance to strike when it comes to the Fed. Going forward, when you're talking about some of those tools and you're saying they're not using all the ammunition they possibly have, what could they do in this scenario that you feel would make the appropriate impact?
So in an optimal world, they hand off. They hand off a very heavy policy burden that they've been carrying for too many years to agencies with better tools. So when you look at what the US needs, if you look at what Europe needs, none of these policies fall in the domain of central banks. Pro-growth structural reforms do not fall in the domain of central banks. Better fiscal policy does not fall in the domain of central banks. Education does not fall in the domain of central banks. So this is about handing off to other policymakers. The problem is that central banks have been looking to hand off, but there's no one to hand off to. And that's why the probability of a policy mistake by central banks has been going up, and that's why we get this notion of flip-flopping, and that's why communication has become so much harder.
Mohammed, you've spoken a lot about Europe, and I feel markets have actually completely relegated what's happening there to the background. No one talks about it. Maybe they will now that the G20 is behind us. Attention will move back to Brexit somewhat. Trump has called off those tariffs. At least, they'll continue to discuss them. We've seen no growth in Europe, as you know, and the markets don't seem to be overtly worried about the resulting impact of that on the rest of the world currently. How do you explain that?
I think that's an absolutely correct assessment and an absolutely correct concern. Europe has been off the radar screen, even though the growth challenges are a lot harder than what faces the US, even though the challenges facing the European Central Bank are a lot more than what faces the US. But somehow Europe has been off the radar screen, and that's because people have been focusing on trade policy as opposed to a more holistic view of what's going on. So I do worry about Europe. When I think of where the major systemic risk is, it's Europe, and it's about stall speed. It's about this notion that even though they'll grow by 1% or below, it's not fast enough given the debt dynamics in certain countries, given the more difficult external environment, and given the political developments. So you're absolutely right. We should be looking more at Europe and assessing its outlook, because that is the major threat to the global system right now.
So I know that you're not a pessimist, Mohamed, but what do you feel could be the worst case scenario over here? I can't really see them getting out of this mess at this point. I can't see that visibility. What, however, would be the worst case scenario on the downside?
So both the worst case and the best case scenarios come from the fact that you've now got a feedback loop between economics and politics. For a long time, it was about poor economics defined as low growth that is insufficiently inclusive. It was about poor economics creating messy politics. But the feedback loop into the economy was interrupted by central banks. Now we're seeing messy politics starting to contaminate the economics. So you have the possibility of what economists call multiple equilibria, which means one bad outcome increases the possibility of the next bad outcome. Or in other terms, you don't get reversion to the mean. So you get this self-fulfilling dynamics between economics and politics. So the bad scenario is that it feeds onto itself, and next thing you know, the economy is too weak for the reality of this financial situation, which means the politics become more polarized, which means nothing gets done on the economy, and then you end up not just with low growth, but low growth and a high risk of financial crisis. But there's another side to that. That is, as things get worse, you may get what Europe needs in terms of wake-up call. The common mantra in Europe is that it takes a crisis. That Europe reacts very well to a crisis that threatens its historic project of integration, economic, social, and political. So the hope is that as that vicious cycle starts to be clear, it will be the wake-up call needed. And what's ironic right now about Europe is it's not an engineering problem. There's massive agreement on what's needed. It's about political will to implement.
Let's talk about the rest of the year then, in line with that. And you have said that it will be marred by diverging growth, questions around the industrial structure, bouts of volatility, and central banks having difficulty keeping everything together. Till now, markets have been leading, Mohamed, but even though growth still has a lot to do, growth of catching up to do. Going forward, given the scenario you've painted, do you think markets will manage to sustain the kind of momentum they've seen this year?
So we are living in a world of liquidity-driven markets. If you look at what happened in the first half in the US, you had a 17% gain for the S&P, you had a 20% gain for the NASDAQ. And that came in the context of every single other asset class also going up, including long-term treasuries that are risk-free. So you've had double-digit returns for both risky assets and risk-free assets. That tells you something. And what it tells you is that we are not fundamentally driven, we are liquidity driven. Markets have been conditioned to bet on ample and predictable liquidity injections from central bank. And that's what they're betting on now. Now, what is the risk of that? Is that you get an excessive decoupling of valuations from fundamentals. And that's the risk for the second half of the year, which means that there's a possibility of more volatility and some gapping in liquidity as we go forward.
Where do you see growth in the US going forward, given the macro setup, given the kind of scenario that we've talked about currently and the global dynamics at play? Data hasn't been all that bad, the one that whatever we've seen so far, and even the one that's predicted now in the next couple of weeks. So US growth outlook then going forward?
So I think divergence is the right word, that we are going to see an unusual situation among the developed economy, and that's relevant for the emerging world, of the US doing relatively well. By that I mean 2.5% growth in GDP, solid wage growth of 3% plus, and continued ability to create jobs. And that comes at a time when this period of U.S. expansion is now the longest in history. So the U.S. is continuing to make history in terms of its growth dynamics. The rest of the advanced world looks tricky. As I mentioned, Europe will be at best a 1% economy with a downside risk of stall speed. Japan will be at best a 1% economy. And that's going to raise a lot of issues, particularly in the currency world. And we're starting to hear it. We're starting to hear people say, I don't want my currency to be too strong. And that comes in the context of acceptance that we can weaponize economic tools. So this divergence within the advanced economies raises issues for the system as a whole and raises issues for the emerging world. It is disappointing to me that the G20 wasn't able to collectively address these prospects. Instead, it was about agreeing to a communique that watered down differences, and it was really about the bilateral meetings, particularly the one between the US and China. But it wasn't about collective action and collective responsibility.
All right. Now, I know that you don't track India very closely, but your views from what you've heard and seen so far with regards to Modi 2.0, the new government coming in with a strong mandate, we've got the budget around the corner. Just want to get a sense from you on anything that you're anticipating from the government in the fresh term, policy front, agenda, reforms, anything that you're looking at all.
So I think the three big issues people are from the outside, and I stress that there's asymmetrical information, but from the outside, there are three big issues on the radar screen of people when they look at India. One is that the growth momentum has slowed and needs to accelerate again. Two is that the government of Prime Minister Modi came back with a stronger mandate and therefore better able to implement reforms. And three is the relationship between the government and the central bank. There is worry that central bank autonomy is being undermined excessively. So these are the three things right now on the radar screen. And people on the one hand are very encouraged by the possibility of more reforms, because if you unleash the Indian economy fully, it is about high growth, it is about transformational changes. India has all the initial conditions to be successful for a long time. You just need to unleash these conditions while respecting institutional strength. India has long had institutions that have stood the test of time, and it is really important that these institutions contribute to a growth momentum that is lasting and transformational for the economy.
Given the current scenario with regard to yields, do you feel there is going to be an appetite for Indian debt?
So there certainly is appetite for Indian debt. And the question is, are Indian companies allowed to issue and tap the global markets. But there is significant appetite, and that's for the following reason. First, it's a diversifier for global investors. Global investors are hungry for diversification play, and India, because of its initial condition and potential, is a diversification play. So that's the first reason. Second, people admire the potential for reforms in India. So there certainly is appetite, but I would urge Indian companies, if you're able to issue, do so in a medium-term context. Don't think of it as a one-off transaction. Think of it as establishing a yield curve over time, which means that focus on step-by-step responsible measures so that you come across as a predictable and responsible issuer. That is how you gain low funding costs. That is how you gain predictable support from investors.
So you're saying that investors at this point would rather see the fiscal deficit slip a bit, but definitely more of a focus on stimulus or a boost, reform push from the government?
Yeah, so people think of fiscal sustainability as a ratio that has a numerator and a denominator. The numerator is what we all talk about. It is debt. It's about debt service. But the denominator is equally important. It's about growth. And if the debt is incurred to promote higher economic growth, people worry a lot less. So don't get too hooked up just on debt. The question is it financing pro-growth measures that will pay off over time? And investors will tolerate that. They would rather invest in a high-growth country than in a low-growth country.
Fantastic. Mohamed, thank you so much for joining us on the show today. It was great to get your perspective on so many crucial elements that are shaping global dynamics and an outlook really on economic growth worldwide. Thanks so much for joining us.